Michael Burry makes a $1.6 billion bet against the stock market.
Have you heard the big news? Mr. Big Short Michael Burry has bet against the S&P 500 and the Nasdaq indexes at a time when they have grown 58% and 52% respectively from their 2020 lows. Should this be a concern? After all, Michael Burry is known for predicting market downturns. I mean, remember 2008 with the housing market? Welcome to The Eighth Wonder, a channel dedicated to making compound interest your best interest. In the United States, institutional investors with an investment portfolio of $100 million or more are required by the Securities and Exchange Commission, the SEC, to submit a report on their investment activities every quarter. This report is known as Form 13F and is due no later than 45 days after the end of each quarter. This report helps provide transparency and insight into the investment activities of large institutional investors. The information on this report includes 1. Identification. This includes the names and identifying information of both the institutional investment manager and the investment funds they manage. 2. List of holdings, meaning all the securities that the investment manager holds, including stocks, options, convertible securities, and certain other equity-related instruments. 3. Number of shares. For each security, the form discloses the number of shares or contracts held by the investment manager. 4. Value. The form provides the fair market value of each security in the portfolio at the end of the reporting period. This allows observers to gauge the size and composition of the investment manager's holdings. 5. Changes in holding. The form also indicates any significant changes in the investment manager's holdings since the previous quarter. This includes new positions, increased or decreased positions, and securities that were sold. Individual investors and financial analysts often analyze 13F filings to gain insights into the investment strategies of prominent institutional investors, which can influence their own investment decisions. Among the most interesting filings, you'll have investors like Warren Buffett and Charlie Munger. But if there's one investor who's quite the standout, it has to be Michael Burry, because unlike Warren and Charlie, you can never predict what he's going to do next. His filings typically look very different from each other every quarter and often signal his feelings about the markets. So recently, the 13F filings for the second quarter of 2023 have been released, and as always, Michael Burry's filings garnered a lot of attention. Burry's fund, Scion Asset Management, bought $866 million worth in put options. That's the right to sell an asset at a particular price against the SPDR S&P 500 ETF Trust, an ETF that tracks the S&P 500, and $739 million worth in put options against the Invesco QQQ Trust Series 1, an ETF that tracks the Nasdaq 100. This has raised a lot of eyebrows as people are wondering what it is that Burry is seeing that everyone else isn't. Burry's claim to fame is primarily associated with his successful prediction of the 2008 financial crisis and his early recognition of the subprime mortgage bubble. He successfully analyzed and identified the risky nature of the subprime mortgage market, which was largely overlooked by mainstream financial institutions at the time. He correctly foresaw the housing market's collapse and subsequent financial crisis that had widespread effects on the global economy. Not only did he do this, but he was able to profit millions of dollars along with all the investors in his hedge fund Scion Capital. Burry's story and his successful bet against the subprime mortgage market became so popular that they got depicted in the book The Big Short by Michael Lewis, which was later turned into a movie of the same name with actor Christian Bale as Michael Burry. Burry's fame also brought attention to his unorthodox investment strategies and contrarian thinking. His prescient insights into the impending financial crisis brought him praise and criticism, but his success in profiting from the crisis solidified his status as a notable figure in the world of finance. This brings us to the present day, where the S&P 500 and the Nasdaq 100 all seem to be trending up, with the S&P 500 looking like it's about to hit a new all-time high on the back of what is now known as the Magnificent Seven, being Microsoft, Apple, Amazon, Google parent company Alphabet, Tesla, Nvidia, and Meta, formerly known as Facebook. These 7 companies make up part of the top 10 companies under both indexes and carry a lot of weight. So maybe there's something to look at over there, but who knows? The one common link between these companies, other than their market cap values, is the fact that they are all in the tech space. So maybe, just maybe, there might be something there. I've seen a few people here on YouTube addressing this position by Burry. After all, the S&P 500 and the Nasdaq are pretty much considered the benchmark of the entire stock market, so betting against them is something quite strange. If you are familiar with Michael Burry, then you probably know about his famous tweets, or is it X's? Whatever they're called, where he writes his predictions on what he thinks is going to happen in the markets and then proceeds to delete the post. Since there's an account that is dedicated to saving all of his posts, you might even think of heading over there to try and see if there are any clues as to why he chose to do this. But the truth is, Michael Burry operates in a very weird and unique way. Most of the big investors focus on long-term buy and hold investments with value-driven principles. Michael Burry, on the other hand, seems to follow value, but does so in the short term, which makes him a very unusual value investor. One person even commented on the post about Burrys Bet that for all we know, he could have already exited the position by the time the news even broke that he had purchased those put options. This argument is a fair one since the 13F filing only comes out latest 45 days after the end of the quarter, and a lot can happen within that space of time. Also, despite the fact that there's been a lot of uptake in the S&P 500 and the Nasdaq lately, the market ebbs and flows, and there are days when the market trends down for a while. And since we have no idea as to what Burry's execution price is, there is no telling. Now, as much as Michael Burry has successfully predicted the 2008 housing market crash and made a big bet against it that made him and his investors a lot of money, it doesn't mean that everything he does is a prediction of what's to come, and even if it was, it doesn't mean that he's always right. We've seen him most recently bet against Tesla, only for the stock to soar higher and lose him a lot of money, so he had to exit the trade.
He's been right more than he's wrong. When Michael Burry says, hey, I'm thinking it might rain tomorrow, it's never a bad idea to buy an umbrella.
I think it's a good idea to follow all these big investors and look at what they are investing in. But that should not be the basis of your investment strategy. 13F filings can be very informative, but once we've looked at them, we need to then go and do our own research to see if we can find any valuable information on the companies that these big institutional investors are investing in, and if it makes sense for us to invest, then do so with an understanding of what our goals and strategies look like. As mentioned earlier, Michael Burry is mostly a short-term investor, which is not a conventional way of going about being a value investor. For most of us, sticking to a long-term buy and hold strategy would serve us well, so we can avoid all the pitfalls that come from following one investor blindly. With all the buzz that this 13F filing has created, I think that an understanding that Michael Burry's position is most likely a short-term thing is important. It shouldn't worry us much as long-term value investors, as ours is to look at the bigger picture where this most likely fades into obscurity in the grand scheme of things. To drive this point home, here's Warren Buffett speaking at Berkshire Hathaway's annual investor meeting in 2021.
On March 31st, I ran off a list of the 20 largest companies in the world by stock market value. Those names, a good many of which you'll be familiar to, but they were led by Apple at slightly over $2 trillion. And it went down to the number 20th was worth 330 odd billion. But those are the 20 largest companies in the world by market value on March 31st. But what I would like you to do is look at that list. Of the top 6 companies, 5 of them are American. So when you hear people say that America hasn't, it's not working very well or something of the sort, in the whole world, of the 6 top companies in value, 5 of them are in the United States. It's not an accident, and it's not because we were way smarter, way stronger, anything of the sort. We had good soil, had decent climate. The system has worked unbelievably well. Just imagine thinking of 5 of the top 6 companies in the world ending up with a country that started with 0.5% of the population just a few hundred years ago. But what I would like you to do is look at that list for a minute or two, if you want to, and then make an estimate, make your own guess. How many of those companies are going to be on the list 30 years from now? Here they are, these powerhouses. And how many would you guess are going to be on the list Well, it's not going to be all 20. It may not even be all 20 today or tomorrow, because this was March 31st. But what would you guess? And think about that yourself. Slide 2, which goes back a little more than 30 years, and look at the top 20 from 1989. And if you look at the top 20 from 1989, there's two things that should grab your interest. None of the 20 from 30 years ago are on the present list. None. Zero. There were then 6 U.S. companies on the list, and their names are familiar to you. We have General Electric, we have Exxon, we have IBM Corp. I mean, they're still around. Merck is down there at number. None made it to the list 30 years later. Zero. I don't think it will be zero, but it is a reminder of what extraordinary things can happen. Things that seem obvious to you. Japan had this wonderful bull market for a very long time, so you had a number of Japanese companies on the list. Today there are none, and the United States had the 6. Now we have 13, but they aren't the same 6. I would invite you to think about one other thing as you look at this list. 1989 was not the Dark Ages. I mean, we weren't just discovering capitalism or anything else. And people thought they knew a lot about the stock market and the efficient market theory was in, and it was not a backward time. And if you look, the top company at that time had a market value of $104 billion. So the largest company in the world, Tidal, in just a shade over 30 years, has gone from $100 billion to $2 trillion. At the bottom, the number 20 has gone from $34 billion to something a little over 10 times that. That tells you something about what's happened with equality, which is a hot subject in this country. It tells you a little bit about inflation, but this was not a highly inflationary period as a whole. But it tells you that capitalism has worked incredibly well, especially for the capitalists. It's a great argument for index funds is that the main thing to do was to be aboard the ship, a ship. They were all going to a better promised land. You just didn't know which one was the one they'd necessarily get on. But you couldn't help but do well if you just had a diversified group of equities. U.S. equities would be my preference, but to hold over a 30-year period. But if you thought you knew a lot about which ones to pick, or the person that you had hiring, you were paying a lot of money to, had all these ideas, it could tell you their best ideas in 1989 did not necessarily do that well, although overall equities were absolutely the place to be.
Warren shows us that over a 30-year period, the top 20 companies in the entire world have completely changed. But here's the interesting thing. An index fund like the S&P 500 is one of the safest bets you could have made with your money. Over those 30 years, the companies that made up the fund may have changed, but staying invested in the fund would not have lost you any of your money. This is an advantage that investing in index funds has over individual stocks, where you lose your money if the company stock goes down a lot for whatever reason. You may not be able to predict which companies will do well over long stretches of time, but you can bet on the market doing well. This is my big takeaway from Warren Buffett. So if I were you, looking to make an investment for the long term, then this would just be news. If I'm looking to invest for the short term for whatever reason though, then I would tread with caution. So that is a big story surrounding Michael Burry and his latest 13F filing. What are your thoughts on Michael Burry and his unusual style of investing? Are you worried about this new bet? Comment below and let me know. Maybe I might have missed something that you can enlighten us all on. If you found value in this video, then please leave a like and share it with a friend. Subscribe to the channel if you haven't already done so, and click on the notification bell to stay informed about the investment world, its ups and downs, and more news on Michael Burry. Thanks for watching. Hope to see you on the next video. But until then, stay invested.